Hello and welcome to Your Money, Their Hands. And this week we've come to Schroeders and Andy Brough. He's the manager of the £1.7 billion mid-250 fund, UK fund, I should say. Andy, also your 10th anniversary. You were there at launch.
Yeah.
It's been a testing time for 250s. The worst you've known?
Well, I think over the last 10 years, it's quite interesting. You know, if you started off, when we launched the fund, the FTSE 100 was nearly 7,000, and now it's sort of, struggling to get through 5,000. So in 10 years, you've kind of lost 40% of your money in capital terms, haven't you? In the mid-250, during that time in the fund, £1's become £2. So, mid-250 companies are, by their very nature, a lot more dynamic than sort of FTSE 100 companies. During that time, you've seen a whole huge turnover in the constituents of that particular index. I think 70 or 80 only of the original ones are left. So you're always capturing what is hot at the moment or the recovery stocks of tomorrow.
Now, you're quite rigorous. I've been looking at 73 holdings is what you have in maximum. I mean, what are the things at the moment? How do you pinpoint those targets, investment targets?
Well, there's two sorts of companies I'm looking for at the moment. Those which can demonstrate top-line growth, because we are in a very challenging, as you mentioned, business environment. So, in particular, outsourcing companies, the government's going to have to cut huge amounts of spending. And so any outsourcing companies, to me, look quite attractive, be it sort of Babcock and Ceridian, which are two of my three largest holdings, and all special situations where you've got really big discounts to net asset values. One that's popped up a lot in the last 2 days is Punch Taverns, trading at over 50% discount to NAV. We backed the fundraising quite extensively and bought further shares. So really, it's those two sorts of companies I'm looking for. You want to kind of stay away from the middle ground where companies are under increasingly competitive pressures, costs are rising, it's hard to get price increases through.
So in terms of company visits, do you find that it's much better seeing them face to face, and can you exert influence on where you think things need changing?
Well, you can always tell them what you think.
I think they'll listen.
Yeah, you can tell what you think. But I probably see 3 or 4 companies a day, and I think it's, especially at this sort of time, where there's so much going on, no one's quite sure how things are going to pan out, then you want to stay quite close to companies because they're going to tell you how they see it. At the moment, everyone's saying, well, we haven't seen any sign of the pickup. We can't really understand why the stock market has suddenly gone up by 40%. Since March, and I think we're going to be talking to companies a lot more, especially over the next sort of 6-7 weeks as they come back for that final quarter of the year. And if we don't see a pickup then, I think you're going to see quite a lot of disappointing statements from companies. So we're really looking at the portfolio, as I said, trying to concentrate on those which can weather this sort of downturn on a consistent basis.
I mean, looking forward to the final quarter is so important, of course, as you say, people rearranging their portfolios when they've come back after a summer break. Are you optimistic?
I think we've probably seen the best of the market in the short term. I was optimistic back in March. Indeed, I've sort of went on TV and said I thought that the green shoots were coming through. I think the stock market has rallied very hard in a number of areas. I think what you're going to have to see now is either companies delivering the sort of improved trading which the stock prices are forecasting, or you have to see a return to corporate activity which justifies some of the prices out there. I think there's very little room for disappointment in a lot of sectors.
Now you've mentioned the industrials and Premier Oil, a bit of healthcare and some consumer, Wetherspoon in fact in the pub world. Are there any sectors that you actively avoid at the moment? I'm
very light, and I've been selling property as one sector. I think when I joined Schroeders 22 years ago, people were writing 25-year leases. They're now coming to an end. You might get a 5-year lease if you're lucky, maybe a 10-year lease. Rents are going down. And the same with sort of house building. I've been a bull of house building in the past. I'm virtually down to my last couple of holdings now in house building because I think we're in a situation where 1/3 of the working population have had their wages cut. It's very hard to see that house prices are actually going to really increase from here. And a lot of the company's shares have sort of gone up by 30 or 40%. And I think that's more than captured the future upside. And people are just assuming that interest rates are going to stay low. Let's say the government has to borrow more and more money, then the Bank of England can't keep buying all the gilts. And sooner or later, interest rates at the long end are going to have to rise to reflect the increase in demand. And that's going to affect not just the house building sector, but also the property sector.
Andy, thanks very much indeed.
you.
And happy birthday in November.
Thank you very much.
And that was Andy Brough from Schroeders. He's the manager of the Mid 250 Fund. And that's it for this week. But don't forget to keep up to date with all the latest news and views and personal finance analysis online, and of course in the Saturday and Sunday papers. Thanks for watching, and please do join us again next time.